Okay. Good evening and assalamualaikum,
Good.
Jamie,
Oh,
Revati, Omar, Yi. So how's everybody? Okay.
thank you, Prof. Everything is great. How are you, Prof?
Okay. So today we will continue. This topic is on the feasibility. We'll talk about feasibility today, feasibility and viability of entrepreneurship. It is somehow different. Uh, most think there are similarities with other businesses, and then there are differences because in terms of entrepreneurship, especially on the startup, yeah, uh, the goal are not clearly determined. Unlike any business as usual, the goal is clearly determined in your strategic planning. When you do your strategic planning, you have determined the goal, and then you are setting up how you're going to reach to your destined goal. Yeah, so entrepreneurship is not that it's quite different. Let me share. I will move up. Okay. This is topic 6. So entrepreneurship, we have covered this in the first, I think much more detail in the first class. So entrepreneurship is about innovation. Yeah, this is we take the uh, article writing of Joseph Schumpeter in 1934. So it is about innovation, and Kirsner, Bloom, I think all the other authors talk entrepreneurship is about uncertainty. You're not sure. And then Sarasvati, 2001, mentioned entrepreneurship is about effectuation. So you are looking into not the process, but you are looking into the effect. And then we are not yet determined how we are going to, where we're going to arrive. Comparing the managerial thinking, it is about causal thinking. So causal thinking, you have a given goal, and then you have to provide the strategic or top level management have provided you the goal. So the goal has been given, and then you need to find the means how to achieve the goals. Yeah, so you have to achieve the means based on the goals that have been given to you. So there are top level management, there are middle level management. This middle level management are termed as functional or tactical level. So the top level management has decided on the goal, the strategic level management have decided on the goal, and then it is the tactical management which is supposed to achieve, to design or strategize or create tactics how to achieve the specific goal. Maybe you have a marketing goal, you have your production goal, and so on. So it is means to achieve a goal. So that is the managerial thinking. But when you take it at the entrepreneurial perspective, we are given means. You have resources. You have technologies. You have maybe you have market segment. You have problems, and then you have people. You have resources. You have your partners. So you have given means. You're given means, but you do not know where you will arrive. So the goal is about the end is imagine. Then you can say you will start somewhere and then you may achieve somewhere else. Yeah. So for example, for those who are aware of Malaysian geography, say for management, for managerial thinking, I'm from Kuala Lumpur. I want to go to Singapore. See, Singapore is southward, so I will go drive towards Singapore, downward towards Singapore. So I will arrive to Singapore. meaning that there are several routes that I can travel from the north, from Kuala Lumpur, which is is a central region in Malaysia, going towards Singapore at the south. So that is managerial thinking. But if I arrive in Bangkok, it is failure to me. Managerial thinking. If I arrive in Bangkok, suddenly I wake up, I ask my son to drive for me. Okay, I have a son who can drive. I have four sons who can drive. Say, okay, I want to go to Singapore. And then take the steering wheel and he drive. And waking up in the morning, I found myself in Bangkok. So we are supposed to go Singapore, and then we arrived in Bangkok. So it is a failure to him. That is managerial thinking. But entrepreneurial thinking, no. We are given a set of means. So say the steering wheel is with him. So he determined where he want to go. So I say I want to go to Singapore. So he just drive, and then we end up in somewhere, say in Kota Baru or in Penang. Say I arrive to Penang. So that is the goal that we achieve. So it doesn't mean that we have to achieve our desired goal. That's why when there are products, for example, like uh, Viagra, for example, Viagra, which was meant to serve to handle heart problems. Viagra was meant initially meant to handle heart problems, but it ended up solving other problems. So these are things happen in entrepreneurship. And then, for example, like even Java language was meant to do something else, and then it achieved something else. So entrepreneurial thinking, you will achieve something from your a given set of means. That is effectual thinking. So effectual reasoning. So you can read much more detail. Actually, you can find articles by Saraswati. Because it is about innovation. We have innovation that is our resources, and then it is about uncertainty. We are not certain where we will end up. Yeah, maybe Jamie, we have some plans to do in Philippines. For example, you have your goals to do in Philippines, but you may arrive somewhere else. You may achieve something else. Yeah, so we do not know. So you read also article by Saraswati, 2001, on effectuation theory. So so effectuation is about so comparing, this is causation processes, which is the management processes, is called causation processes. The effect is given, and the result is given. So you will achieve between the means to achieve the given effect, meaning that you have several solutions. Remember, when you want to make decision making, you will start with problem understanding of the problem, and then you will do that is called intelligence, and then you will design the solution. You will design several alternative solution, and then you will have a choice to choose the best solution based on the payoff. Yeah, so you will choose between the means. How do we achieve the given effect? So the selection criteria will be based on the payoff, which is the expected return. If I do this, how much will be the return? If I do this, how much will be the return, and so on. It will be effect dependent. So your choice of means is really be characterized by the effect of decision maker, that how they want to create based on the possible knowledge that they have on the means. So, and then it is about exploiting knowledge. So we have people in marketing, people in finance, people in to exploit knowledge. So we employ competencies to achieve the desired goal. So it is more ubiquitous in the nature, and then more static, linear, and independent environment. Yeah. So the focus is on predictable aspects of the uncertain future, things that you can predict. And then, so once we can predict the future, we can control it. We learn this in our predictive analytics for those taking business intelligence and analytics systems. So we can predict the future based on the models, and then we can control it based on the desired goal that we plan to arrive, to achieve. So outcome will be a market share on existing market. It is business as usual. So we have, the situation. It is not something which is innovative, that is something which is uncertain, something that you are not aware, you do not know. For example, like maybe I will not say Grab, but I will say Uber. When they started, they wouldn't know where they will be in the future. Airbnb, when they started, they do not know where they will be in the future. So does Apple or Microsoft. Those innovative businesses, they do not know where they will end up. So, so there is no an existing market when they start up. There is no existing market. They do not know how much share of the market size they will acquire. Yeah, but in terms of entrepreneurship, we do not know where we will end. So we will given some means or tools that we can use. We have innovation. So we have new techniques. There are technology developments that we have, and then so we do not know how we will where will be arrive, and then there are so much of uncertainty. So we will use the possible between the possible effects by having this means. Say you have a technology, so blockchain technology. Say blockchain technology. Where will you go from blockchain technology? You can use it from supply chain management in managing the supply chain. Can you use in the trade finance? You can use in the trade finance. Supply blockchain can be used in trade finance. Blockchain can also be used in handling logistics for fulfillment. When you're selling product, e-commerce, there is fulfillment. You want to monitor your fulfillment, achievable fulfillment. So there are many possible effects with the given means. With just the blockchain, there are a lot of things that you can go. So you can trial and error and so on. So you have the selection criteria will be based on how affordable, how loss are you willing to afford, how much loss are you willing to afford, and then how much risk are you willing to accept. So you can venture into something new that you can afford some loss, or everything, and then you can accept some risk. So it depends on the actor. It's not effect dependent. It's so much on the actor dependent on you. It depends on the entrepreneurship. That's why when you do any research on entrepreneurship, it is not about the organization. It is about the entrepreneur. The entrepreneurship is not about the organization. It's about the entrepreneur. We can have uh, the term entrepreneur, the normal entrepreneur that we see that start up businesses and do their own businesses, or you can also be an intrapreneur, which is who are working in an organization but take risks, willing to take risks, venture into new things, do innovation within the organization. So it is actor dependent. So these entrepreneurs will be given some specified some means, so, and then the choice of effect will be driven by the characteristics of the actor, of the entrepreneur. What do they know? What sort of knowledge do they have? So they can embark into things that they have no experience of, or they embark into something that they are familiar. Um, and then they will use their ability to discover and use contingencies to achieve something that very innovative. So not their desired goal or something else. So it is about exploiting contingencies, not exploiting knowledge. It's about exploiting contingencies. So when you arrive, say you are supposed to go to Singapore, you arrive to Penang. So what do you have in Penang? So you can sell something, you can do businesses in Penang, yeah, exploiting the contingencies. And then it is more about human action. It is explicit assumption on that. It is very dynamic, non-linear, and ecological environment. And then it focus on controllable aspects of an unpredictable future, unpredictable future. The future is unpredictable because according to Kirchner, and even you talk, say, Adam Smith and Cantillon, it is about uncertainty. Entrepreneurship is about uncertainty. So the future is unpredictable. So we are not talking about predictive things that we can know, we can expect, but things that we cannot expect. So how can we go to the extent that what the sort of future that we can control, but we do not predict the future. So we will arrive where we do not expect. We can achieve new market by creating alliances, cooperative strategies, and so on. So that is effectuation processes. So you can compare the causation processes that you learn in your business management. And then in this course, we learn about entrepreneurship, which is which deals with risk, deals with uncertainty, deals with things we don't know, and then it is about effectuation. It's not about, it deals about innovation. So it's not about uh, a desired goal, a targeted goal that you have been given, and then you find the means to achieve that goal. It is about the means that you have, and then where do you may end up somewhere else. So when you, for management, if you plan to go to Singapore, you arrive in Singapore, it is it is uh, it is a success. But if you arrive in Penang, it is not a success. It is a failure. But for entrepreneur, okay, you have a car, you have something, so you will go. Maybe you want to go to Singapore or where. So, but you arrive in Penang, so it's still uh, a success. At least you will arrive somewhere. Okay. So when you look into this business model canvas, there are viability in terms of how do you look into viability of your business. There are feasibility, desirability, and viability. And then when you go back to your business model canvas, desirability is about what do the customers want. You determine your customer segment, and then what is your customer relationship, and then the value proposition. Remember, value proposition is not the product. You can go back to the lean canvas. I think in the previous slide, the previous topics, topic two, I think topic two or topic one, we have this lean canvas. You can lean canvas clearly distinguish between value and product. Product is the solution. Value is not the solution. Value is a higher level. Yeah, so you can read about it. Think there are some articles as well comparing. Yeah, value is not the product. Value is how, for example, mineral water is to quench your thirst. It's not the water that you're talking about. It is the quenching of your thirst, removing your thirst. So value proposition that, so you can look at the business model canvas again. So there are values. And then desirability is about the customer segment. How do you deliver value to the customers? And then how do you build relationship? And then what will be the channels? You can see the green boxes here. Let me show the pointer. Green boxes. Customer segment, your value will deliver value to the customer segment. So you determine the customer segment. The customer segment must be the customers must be related to the value, and then what is the relationship between the customer and the value, and then what is the channel that you deliver to you use to deliver the value to the customers. So channel can be the 5 components of channels, which is number one, creating awareness, pre-sale, sales, delivery of services, and as well as after sales service. And then you look into the key activities. How do you achieve this? How do you achieve this? You will have a key partner, you have key activities and key resources. Yeah. How do you achieve what they desire? How do you provide what the customers desire? How do you deliver them? That is the feasibility part. Feasibility part is where you have your key partners, maybe your supplier raw material, or so there are certain products that you OEM, uh, or there are contract manufacturers behind, and then certain things that you do in your organization, your key activities, and then what are the resources that you use, your physical resources, financial resources, and so on. So this is feasibility. How do you build them? So comparing feasibility and desirability, so making up uh, something that you will deliver, provide to the customer, and then the viability. Viability, whether it's viable or not. Your revenue stream must be higher than the cost structure. How do you get your payment? And then what is the cost structure? Cost structure related to the partners, key activities, and key resources. There will be cost component to it. And then the value proposition, customer relationship, customer segment, and channels, there will be income related to it. So the right side and left side. The right side will be related to income, which is the revenue stream. Who will pay for the service that we deliver? Sometimes it's not the direct customer. The direct customer consume the product free. Maybe you provide something to the public consume it free, but there are people who pay. For example, like when you build a web or in an app, sometimes it is paid by advertisers. Advertisers will be the and then but consumption is used by the public. So you need when advertisers want to have large market size. So or the government paying. Government is paying, so you deliver the service, but the government is paying. And then actually the customers are paying tax to the government somehow. So this is the revenue stream, and then the cost structure. What will be the cost that you want to build or deliver your service or activities, your partners, your resources? There are cost component to it. So that this is the viability that you can look into in your business model canvas. Okay. We move on. So feasibility and viability in BMS business model canvas, we look into the right infrastructure. Feasibility, when we assume that you choose the right infrastructure to execute your business model. Go back to the business model. Remember, the first topic, second topic, we talk about business model. And desirability is what will create the customer value. It's about the value proposition. It may be brand, it may be a low cost. You reduce the cost, something that they are not be able to gain currently, so they are able to gain. For example, like Air Asia, they put their words, their motto is everybody can fly. Before we have Air Asia, no, everybody can fly. Can say everybody can fly. So desirability is about the value. Everybody can fly. So viability is the financial assumption so that you can earn more money than you spend. So the revenue stream must be larger than the cost structure. It wouldn't work if the cost structure is larger than the revenue stream. Yeah, so that is the viability. Adaptability is you look into the competition. You can the basic model will be on PESEL, politics, economy, social, and so on. So how do you adopt and adapt certain situation in your context? You may have a certain situation in a foreign country, but you want to adapt into your country. So feasibility analysis is how do you determine whether the business idea is viable. So it is a preliminary evaluation on your business idea. So you need to have, I do not cover lean canvas here, but if you do the lean canvas, there is a matrix. You need to get some figures, actual figures, statistical numbers that you can crunch, and then you can do some assumptions in terms of your market penetration and so on. So you determine whether your revenue stream is higher than your cost structure, the cost components. So it is best that you conduct the feasibility analysis early in your during your business before you set up your business, so you can pick up some metrics measurement from the statistics, whatever you can get in terms of your market segment, target market, and then you work out the figures. So you determine the uh, so this is the components that you look into the feasibility. When you have a proposed business venture, so you have your business idea. So you look into the four components here, which is the product service web feasibility, industry target market feasibility, organizational feasibility, and financial feasibility. So if you have yes in all area, your product is feasible, your industry is feasible, your target market is feasible, yeah. Your organization is feasible. You have the right people. You have the business acumen, business prowess, organization management prowess, and then your financially it is feasible. So if it is yes in all area, you proceed with the business plan. If you know in any one of this area, one or more areas, so you drop the business idea. Your product is not feasible, meaning that people do not want your product. So where do you sell? You have to find the market that people need your product. So and you get the market that need the product. So you have Product is feasible, and then the target market is feasible. You have a target market. If you don't have a target market, so still you will not be able to sell. Organizational feasible, meaning that you can deliver the product. You can deliver the product, meaning that you can develop the product, you can design, you can produce the product, and then you can manage uh, the finances and so on. So organizational feasible. Financial feasibility, meaning that, or in all cases, your revenue will be larger than the cost. If your cost is larger than your business, it is a downward you move down in the graph. There is no contribution margin of the product, so you will drop the business. So we'll go one by one. Yeah. So we have product and service feasibility, industry or target market feasibility, and then we have organizational feasibility and financial feasibility. So in terms of product feasibility, there are two things. We look into the product desirability. There is people who desire your product, and then people who demand the product. People desire, but they don't demand. They don't know, they are not able to pay. There is no demand because it's too expensive. I like the product, but it is too expensive, so the demand is not there. So there is demand, and then industry is attractive. Part B is on the industry target market. The industry is attractive. Oh, this is a very good industry. It's promising industry. Say now people moving into SMR, maybe you're familiar or not. Standard modular reactors, small modular reactors, small modular reactors. Are you familiar with small modular reactors, Jamie? Anybody familiar with small modular reactors? These are small nuclear reactors. Small nuclear reactors, they don't use uranium or plutonium, that they use thorium, which is smaller radiation compared to uranium or plutonium. And then this thorium is even small unit of thorium being placed in to cater for industry. So every industry can generate their own clean energy. It's not you don't have to create river, create water like hydroelectric. You don't have to say put up very large solar power. You didn't have to create a tall wind 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 generators, yeah, so on. But you just have a small unit of reactors, nuclear reactors, where uh, uh, these minerals are dig from the soil, and then it produce energy, and then you trap the energy so you can heat up water into steam, and then the steam will run the turbine. This turbine will generate electricity enough. It doesn't stop actually until it deteriorate. There is called half-life, and then enough to cover a large size of industry, a large size industrial plant. Yeah, so industry is target, but your target market.
Is
Yes,
that available in Malaysia?
it's not yet in Malaysia, but it's being worked in certain country in Russia, in India, certain countries they have implemented. Not yet in Malaysia. That the target market, say in Malaysia, it is not attractive in Malaysia because we have a taboo here. So the industry is attractive, but part two, you look at part two, industry is attractive. There are a lot of demands. For example, estate, they don't they cannot build up electrical cables. A lot of estates in far and in Sabah or Sarawak, actually they generate their own electricity by diesel. Uh, but if they have this, so they don't have to buy diesel. So we can use this SMR model, for example. But the target market is there is a taboo in Malaysia that nuclear is just to build weapons. Yeah, so the target market is not attractive because the target market is there is taboo in this context. Yeah, that is just an example. Maybe over a period of time, where people will accept XMR. People, if you're keen, you can check SMR, and then yeah. And then in terms of organizational feasibility, we have management prowess. So then we have people with good management skill, functional areas like marketing, finance, operations, and so on. And then resource sufficiency. You have the right finance, amount of finance funding, and right people. Yeah. So, so you have resource sufficiency. That is organizational feasibility. And then financial feasibility, where you have, do you require the total startup cash? So we have what we call 3F, family, friends, and fools who are going to fork up some money for you to start up your business. And then you look into financial performance of similar businesses. So there might be not the same, but closely similar businesses. So you look into their financial performance so that you can look up what will be their revenue stream, or you can fine tune or can innovate the revenue stream, and then what will be the cost structure. And then you can look into the overall financial attractiveness of the venture. You're looking into the ratio, the gearing ratio, and so on. So then you provide your overall assessment. That is a feasibility analysis of your company. So we have product service. We start with product service feasibility, where we have is provide an overall assessment on the appeal of the product. So we had, there are two types of appeal, to the customer as well as to the investors. You need to have some investors to invest in you. So the appeal should be not just for the customers, but as well as for other stakeholders, maybe your investors, the regulatories, and so on. So it is, we should, what is it, what the customers want? And then is it what the customers are? Actually, if the customers want, you can get an investor to invest into it. So you have the product service desirability, and then the product service demand. That is product service feasibility. So the product desirability, whether the product makes sense, is it reasonable, is it something that your customer will get excited, does it take advantage of the environmental trend? For example, we talk about financial technology today. So does it take advantage of the environmental trend, and the people moving away from the physical money into cashless, into digital? So does it solve a problem? Does it take advantage of the gap in the marketplace? You look into non-bankable community, for example. Okay, there is people who have some problem, and then you solve the problem. So whether it is the good time to produce the product, to introduce the product to the market, and then what are the fatal flaws of the product in the basic concept? For example, risk to the users, risk to the consumers, uh, and then yeah, for example, like I say, when I'm working on this SMR as well. Small modular reactors. We are look I From the ITN, I'm looking at the detection of the we call it uh, the we call it an abnormals or irregularities, anomalies. We call it anomalies of the radiation, anomalies of the radiation, so fluctuations of the radiation. So we will detect them, and then we will improve the we call it S3S, safety, security, and safeguard of the radioactive materials. So is there any fatal flaws? So when you can improve the fatal flaws, so the product will be more desirable. Yeah. And then you can, this is the first step, and then you can do a concept test. Some people call it POC, proof of concept. Yeah, so you can have a concept statement, and you can develop, POC is much later. Just create a develop a concept statement, one-page description of the product, and then get the idea, do some brainstorming, ask some people, some possible venture capital or angel investors, and then get some idea how do you can improve the product. That is just something like the target market and so on. So that just do a concept statement and then get that is the how do you determine the product desirability. When you do a concept test, you get responses, get feedback from the people, so you can improve the idea, and then you can create the desirability. You can gauge the desirability of the product. Once you gauge the desirability of product, and then you look into whether there is demand. So you talk face to face with potential customers. You can also use online tools, uh, monkey, we call it, uh, do some surveys, yeah, survey monkeys, and then you can check the library, internet, or you can do your own gumshoe research. Yeah, so first you can do talk face to face with potential customers. How do you get some ideas from them, whether there is demand, and then use some online tools, get administer some surveys, look into Google Trend. You can type the product that you want and then related product and see the trend, whether people search about it in the uh, search, Google search, or and so on. And then you can use AdWords to look into to get landing pages where the people get more information on it. You can do Survey Monkey, Q&A, site Quora. You can look into Google Trends, yeah, AdWords with landing pages, and then you can do in library, internet, or your own gumshoe research. Yeah? Library research is where you do look into archival data. Internet research, you look into, you type the search in the internet, and then gumshoe research is where you look around information, ask people what they think about the idea, and so on. You do your own research, yeah, on the product. Then you determine the demand. So now product is desirable, and then there is demand. So if you can have evidences, have documents of it, you should create the doc. You keep it for yourself so before you move on, or you can also use it for your and getting angel investors or the seed fund from your 3F. So then you look into industrial feasibility. You don't want to move into a sunset industry. What is the overall appeal of the industry, the target market? Yeah, and then so you look into industry attractiveness, and then whether the target market is attractive or not. The industry is the large is a global, but the target market is your target market, your segment that you target. So you look into the business trend, yeah, whether is it a young industry or a sunset industry, people moving away from the product, and then whether it is in early stage or late in the product life cycle. Is it a fragmented or concentrated market, a growing industry or shrinking industry, and whether it is a must have or want to have, must, needs and wants, yeah, between needs and wants. So is it a substitute of something that you people already have, but you can replace it, substitute, not crowded market. And then what is the for the investors, for angel investors and for venture capital, they want to look at the margin. It is high operating margin or low operating margin, because it will affect your gearing, your loans later, your working capital. And then is it dependent on certain key raw material, for that dependent on price of fuel, for example, then there is price fluctuation of fuel, and then your product will dependent on the product. So what is dependent? Is dependent on whether there are dependent on certain flour or certain commodity. Then yes, if your product is dependent on a certain commodity, so it will be affected by the price of commodity. And then you need to look at the price of commodity. So what is the trend of the price of commodity? If the commodity is going upward, and then your cost will be going upward as well. So you can determine that. If it's the commodity that you use, if your raw material is abundant, then you don't have problem with it. Yeah, so you can expect. So and then you look into your target market. So if is the target market large enough, so you need to look into volume of your volume of business. So, yeah, economic volume. And then attractiveness is more tougher. Actually, assessing the target market is much tougher than the entire industry because you are assessing a specific target market. So you need to get some metrics, data on the target market that you want to do. And then next is now you have covered the industry target market feasibility analysis, and then you move next to the organizational feasibility. Organizational feasibility is your organization. Usually people will come up with a team. You can have your partners, or you are sole business, sole entrepreneur. You run on your own. So, but you need to build a team. You cannot do everything. So you do have. Do you have the management expertise, organizational competence, and then you have the resources. So for this part, organizational feasibility, we focus on non-financial resources because there is a financial feasibility that concentrate on financial parts. The organizational feasibility, you look into non-organizational, non-financial, non-financial into management prowess, resource sufficiency. Management prowess is where the people have ability to manage the venture. Yeah. And then the other thing is on the resource efficiency. We look into your critical resources. Yeah, you should list your resources that you use. And non-financial, exclude financial. What are the resources? The materials that you use, the physical machinery that you use, and then what are the resources that you use? And then can you have access to that resources? Yeah, such as office space, lab space, you need to have lab space, manufacturing space. Contract manufacturer is a resource. Contract manufacturer, your partner, that OEM, key management employee, support personnel, technical, IP, intellectual property. If say you have to pay to licenses, so that is a resource. Licenses, how much are you paying? And then are they affected to another key trend? For example, like currency exchange. Yeah, you look into that, and then you can form a favorable partnership with your resources. That is in the business model canvas. It is key partners. Yeah, so you can have access, ensure assured access to raw materials, assured access to certain services that you do. Yeah, resource sufficiency. Then only we move into financial feasibility. So this is the final component, which is the financial feasibility between the cost revenue stream and the cost structure. So in order to start up, a preliminary financial assessment is suffice. So you need to know how much fund you need to start up. And then you look into financial performance of other similar businesses, and then you look overall attractiveness of the proposed venture. So how much do you need to start up? Actually, you need to determine, essentially you don't need to have, in order to start a business, you don't have to have everything in one shot. You can make it progressive as you go along. So you develop a list of anticipated capital purchases and operating expenses, and then when you can generate the first income. So does it cover? And then you will build up. Look into minimal. We call it bootstrapping. We call it bootstrapping. Bootstrapping, you just do minimal. The term is bootstrapping. If you are not familiar, you can read, you can check into this. Bootstrapping. Yeah, bootstrapping. So, and then to determine what is the total startup cash needed. So sometimes there are things that you don't need at that point, so you don't have to spend yet. You wait later until you acquire. Okay. Okay, and then you estimate the financial performance of another businesses, similar businesses, established businesses. So you can get this from companies' annual reports. Uh, you can look into actually in Malaysia, for example, you can search for the company and then you can buy their financial records, yeah, by their P&L. They publish, but most of the time, these are just we call it financial financial accounts, yeah, financial reports, financial accounts. Okay, when you look into when you want to do projection, when you look into accounting, there are two types of accounting that people use. One is called financial accounting, the other is management accounting. Financial accounting is meant for external people from the business. It meant for the regulatories, it meant for the shareholders who invest into them and so on. It doesn't provide any detail or deep detail on what the businesses are doing, how the business work. But there is another set, we call it management account. Management account are the details. So usually managements use management account. In the management accounts are where the detail of operations are, and then it will be consolidated, group, and then put on into a financial account. And then it is a financial account that they send for audit purposes, or for audit will look at both. And then also the statutory reports for taxation purposes and so on. It is the financial accounts. And then it will be in Malaysia, we put into registrar of or SSM, the Register of Companies, so that uh, public can have access to that. But if you get these reports, you can get this for a fee. Yeah, usually for a fee. In Malaysia, you get to for a fee. But they are also for listed company, you can also get it free. They will publish it. You can download it from their websites, but it doesn't go so much detail. But you can work around. How I actually have been doing that. You can work around. How do you do that? You get the financial accounts and then you look into the notes to the accounts. You embed the notes to the accounts to the financial accounts, and then you can recreate sort of, might not be not precise, but you can recreate the management account. So you are looking at the management account. We want to see the management account, not the financial accounts. Financial account doesn't really provide whether the especially when you look into the contribution margin. You do not know whether when is the product will be making profit or when they will be break even and so on. It will not be shown in your financial accounts, but it can be shown, will be shown in the management account. So uh, you need to fill up the financial accounts using the details in the notes to the accounts. So at the back of the financial reports, there will be notes to the accounts. The audited accounts at the back that are audited accounts. You can take that and then you can put in some assumptions. These assumptions you can get from the um, industrial standards. You can price earning ratio. And those things are ratios that you can get the industrial standard, and then you can make assumptions, and then you can rebuild the management accounts. So the idea is not looking into the details of this company. Actually, you want to look into your venture. You want to compare what would be your venture there. Say you want to produce a product. Say you want to determine how much will be, say, for a hotel, for example, for a restaurant. What would be the best ratio between your raw material and then between your salary? So you need to have some ratios. How much you will pay your salary, how much you need to pay for your raw material. So that is some ratios there, and then you can compare the ratios, and then you can be predetermined, sort of predetermine what will be your raw material cost, what will be your cost for salary, and then you can plan for your new venture. So this is how you do that. Yeah? So you need to get a similar financial performance of a similar startup. So the goal is not to look into this business, but it's actually to build your own pro forma. We call it pro forma. Yeah. So you will that create your so then you will look into the financial attractiveness of your investment will be built up using this figure. So you will create, so you need to do a projection based on this market. So once you have this set up, and then you can look into the 3 years, you can also get the 3 years and the previous trends, and then you can target the trend of increment of cost, increment of revenue, and so you can do some projection. Based on the target market you have determined just now in your target market attractiveness, you look into that, and then based on the size of the target market, and then you can project expansion of your market. Maybe you will start in a certain country and then you move to a neighboring country in years to come. So you can do the projection, so you can create your financial growth. Yeah, so 5 to 7 years. So you based on the market. So you cannot pick up figures from the sky. There are people who just pick up the figures of the sky. I've been doing evaluation from I this is my role before I became academic. I evaluate ventures. So and then I need to see the assumption. Where do they get the numbers from? So it must be reliable. It must be based on the say uh, for example, population. Say you want to venture in Malaysia, the population is 34 million. So how many of Malaysians are affordable, can afford? So say you cater for certain age group, and then how many of them are on that age group? You can look into the demography, and then say your target male or female, how many of them, and then you target certain region in Malaysia, for example, central and on, and then you will start from where, and then you cannot be beyond the number of the numbers that provided in the statistics. So you will do a you will project the growth, and then you can so you can develop a forecast of income expenses. Yeah? And then you need to have internally generated fund to sustain. Internally generated fund is fund that are being generated from your actual operational business, not from business coming in or from fund coming in. For example, okay, if you project the fund coming from investors, so it is not worthwhile for the other investors to come in, because you will be solely dependent on capital injections. It need to be internally generated fund. And then you need to determine how the investors could exit. So exit strategy. But when I first came into the academic, a lot of academicians are not aware of exits. So when say, oh, why do you want to study exit? Exit is very important for venture capital, because venture capital, they don't want to stay in your company. They need to exit. They target exit at least 3 years. They will exit. I mean, 2.5 years, 3 years, they need to exit. So how do they exit? Because they need to take up their money back, and then they will invest into another venture. So they come in, they throw in some money for you, certain percentage, 1 year, 2 years, 3 years, and then they are out. So you need to build a pathway for them to exit. So say some companies, some companies can go for Nasdaq, for example, like Grab. Grab move to Nasdaq. They move into the venture capitalists in Singapore, and then they move to Nasdaq in US. There are also um, the IPO opportunities in Malaysia, and then there are other means that you can plan for the company for the investor to exit. So you look into the exit, how do they convert back their equity into cash? So the financial management aspect in this feasibility is looking into how do you raise money, and then how do you manage the finances so they get the highest rate of return. So for example, the venture capital, they expect to achieve 25%. So how do you to make more than 25% so that there is at least some money return for the initial shareholders? So you look into how the venture will track its financial progress, and then how will it forecast uh, their future income and expenses and then they will prepare a projected financial statement. We call it pro forma financial statement. So financial management will look into how well, are we making money or losing money? How much cash? We look into the quick ratio. We call it quick ratio. Quick ratio is the current asset over current liability. And then do you have any cash? We look into the liquidity. They look into liquidity ratio. And then how do you utilize your asset? asset turnover, and then stock turnover, and then we look into your gearing, whether they have be able to meet their short-term obligations, their gearing ratios. You learn this in accounting, gearing ratios, and then the gross net profit. You look into the contribution margin, contribution margin. You look into the CVP, cost volume profit analysis, CVP analysis. You look into the break-even analysis, and then where do we get the fund for capital improvement? So you need to determine, and then who can you partner in, and then are you good in are you in good shape financially? So financial objectives of a firm needs to have good financial. The primary financial objectives for the firm is to have these four. So profitability, the company needs to make profit. So you need to look into profitability ratio. Liquidity, how do they meet short-term obligations? You look into liquidity ratio. You need to do acid test ratio. You need to look into the quick ratio. There are several ratios. This one, you can, I won't go detail on this, but you can read this, you can find, because this one, I think you learn in your financing businesses, accounting. And then efficiency, how did you utilize the asset turnover, uh, asset, and then and then stability, the structure. So debt to equity ratio, your gearing ratio, stability. So you look into this. Profitability, liquidity, efficiency, break-even margin. Yeah, what is the break-even margin? The gross profit ratio, efficiency, gross profit. Yeah, gross profit ratio, net operating profit, gross profit, and then stability. So profitability is the ability to create a profit, that is gross. Liquidity, how does it meet short-term obligation? Efficiency, how they use they turn around the business and then relative asset to the revenue. And then stability, how vigor or strength the business in this financial posture, remain liquid and so on. So you will look into this financial statement. You will create a projected financial statement, and you create a forecast on this. So this forecast will based on the estimate sales and industrial average based on experience. There must be statistical supports, and you cannot just put up figures. So you must find the actual based on the past performance of similar businesses, and then you look into the target market and then get numbers, statistical records, because population, the target market from the, and then you combine, you get your financial forecast. And then you will do budget based on the actual price of your raw material, based on the actual salaries that we will spend, and then what will the capital needed, actual interest rate in the market. So you will use that, and then you put in the financial ratios. You combine financial ratios. You can also use financial ratios based on for example, banks. We have these loan deposit ratios in the market. You can use the ratios in the market, and you build it into your businesses, and then you can also project your own financial ratio. If you have a new innovation, how the new business model or different business model, that will have a different financial ratios. Yes, so you need to. So how the process of financial management, you will develop your income statement, balance sheet, and statement of cash flow. And then from this cash flow, you will do project your cash requirement. And then there are certain things that you don't need cash. For example, machineries, you can have leasing ratio, you can do leasing and so on. And then you can prepare your forecast based on the historic statement. You create a pro forma income statement, balance sheet, and cash flow, and then you do an ongoing analysis, your ratio analysis, and measure the result of versus plan and your industry norms. So these compare it against the industry norms. You need to have some traction before you go and meet any angel investor or venture capital. You need to have some traction, meaning to have to create some sales, and then you can see an actually realized profit, and then you have an actual realized ratio. and not just based on the projection. So historical financial statement will be based on your past performance, and then you have pro forma financial statement is based on your forecast. For example, you have run, say, from your startup, seed capitals, and you have run for a few years, 2 or 3 years. So you have your historical financial statement. You want to meet a venture capital or angel investor, you will create a further 3 years or 4 years or 5 years pro forma financial statements. But usually they will look at 3 years. 3 years is realizable, but 5 years maybe you just create to see the uptrend, to see the trend. Actually, 2 to 3 years only. So the purpose of three types of historical financial statement will be your income statement. You look into the revenue and expenses, whether how you are making profit previously, and then your balance sheet, looking to the snapshot, whether you look into your gearing ratio, your quick ratio, your liquidity ratio, statement of cash flow, you look into the cash position. So whether your company can sustain uh, in from using internally generated fund. Yeah. So historical financial statements. This is an example of consolidated financial statements. This is a financial accounts. Yeah. If you say management accounts, it will be much detailed than this. Okay. Same goes here. This is your balance sheet. And then this is an example of cash flow. Yeah. Cash flow, you have increment of net flat cash flow, and then what is non-cash flow items. You include and exclude non-cash flow items. Yeah. Then you do some ratio analysis to project the standing or the position of your organization. Yeah. For example, return on asset, how much you generate return from based on the asset. If you increase an asset, your generate return will be higher. For example, return on equity, your profit margin, your liquidity ratio, your current ratio, your quick ratio. Your current ratio is current asset over current liability. Quick asset is you exclude your debtors. Yeah, quick asset you exclude your debtors. So debtors is not a quick asset because debtors you cannot people owe you money, you collect you may not be able to collect them quick enough. It's not quick. You exclude debtors. Yeah. Debt ratio, debt to equity ratio. Debt ratio is debt to total asset. Debt to equity is debt to the total equity, owner's equity. And then because okay, and then you generate forecast. Yeah? You will develop a sales forecast projection, and then based on this forecast, you can create a pro forma later, and then you forecast your cost of sales or cost of services, depending on your type of business. And then you will develop your pro forma financial statement, yeah, pro forma income statement, pro forma balance sheet, pro forma cash flow. And then you can even put in the ratio for this pro forma to show attractiveness, to create attractiveness to investors. Yeah, if you need to have investors. And then you do a ratio analysis. Yeah, on your pro forma, ratio analysis on the pro forma. So based on historical, and then you can say projected. Okay, we projected is okay. You can see that you are prudent in your projection, being prudent in your projection or based on the projected are based on the past track record. You don't, you mean you something that is you have, your projection is based with some basis. Yeah, you do it with some basis based on previous historical records. Okay, that is the that is what we covered today. Today we cover the feasibility. So it's entrepreneurship is not about causal relationship, causal reasoning. It's not different from the management, but we apply entrepreneurial thinking. We do not know where we will end up. And then I've compared this, and then we look into the viability and then we use BMC. There are the desirability, feasibility, and viability. And then what is the desirability? What is the desirability? And then feasibility. We'll start with feasibility analysis, and then desirability, viability, and adaptability. And then when you do feasibility analysis, 4 components of feasibility analysis, which is on your product, on the industry, on the organization, and financial lastly. Financial is the most important, but you need to have a yes in all the area before you can proceed, because that is when your idea becomes viable. So this is some product desirability, product demand, feasibility, and so on. Because I might be too fast today, but and then in terms of financial objectives, there are 4 components: profitability, liquidity, efficiency, and stability. Yes, there are ratios related to it. And then how do you prepare your financial statements? Next week will be about forming your venture. Next week we'll cover how do you form your venture? How do you get the fund? How do you get this? So once you have this, now you will need to form your venture. Next week we'll cover forming your venture. How do you get your resources from this? How do you begin with your seed capital and so on? So previously we have covered strategy, we have compared to digital businesses and so on. I think so far, okay. Any questions so far? Okay, I'll stop share for a while. Okay, any question? The notes are in your LMS. These notes are in your LMS.
Prof,
Yes.
so I would like to ask a question regarding the historical financial and also projection. Do we need to include in our assignment? I mean, because
No.
because there is no the-
But if you want to put, okay. But I don't really target this, because it might be quite difficult for you. But if you're doing okay, but it's not difficult actually. But from my experience, it's not that difficult. But I don't want to burden you with that.
the issue, even if we want to include Prof, we have limited words already.
Yes, I know that.
Yeah.
Okay. Okay. But actually, you can, if you want, those who want can put them into appendix and then just explain in the content.
So even for the investment, we need to at least make it 1 year, 2 years, or 2 years, is it? Both?
Okay.
In the
I don't expect this, because there is no projection requirement in your assignment, but just need to create to generate the idea. But actually, if you want to do an actual projection, you need to have at least 3 years. If you are proposing to a venture capital angel investor, you need to have at least 3 years. Yeah. Yeah. Okay, does that answer you, Shazana?
yes, but for assignment purpose?
No need. Assignment purpose, no need.
Okay, noted, Prof.
Okay. Okay, any other question?
Yes, Prof.
Yes, Alice.
Oops, sorry.
Yeah.
Quick, very quick one, Prof.
Yes.
I think our report write-up probably go exceed 3,500 word. Are there any leniency over there if we exceed or
No, I mean, most of the classes is exceeding 3,500. Most of the people, I allow that.
so no point deducted?
No point deducted.
Thank you.
Okay. Okay, yes, Omar.
I was actually going to ask the same question if we exceed the 3,500.
Okay.
Okay, bro. Thank you.
Okay, Jamie, any question, Jamie?
Yes, Prof. I wanted to ask about the risk. So
Okay.
you mentioned about feasibility. You mentioned that entrepreneur, you can go from to Bangkok, no problem. If you're supposed to go to Singapore, you end in Malaysia or in Philippines, that's okay. What about the risk, Prof? How to measure a risk for this entrepreneurship?
Entrepreneurship, actually, actual entrepreneurship is not for your assignment. I don't expect to put some risk assessment for the assignment. You cannot avoid risk, but you can mitigate the risk. You can only mitigate risk. But a lot of these risk components are in management. not because for entrepreneurs, we are risk takers. Entrepreneurs are risk takers, meaning you end up something and then you make do with what you have. So a lot of this risk management is in management, not in entrepreneurship. You can realize that entrepreneurship, they are risk taker. They accept the risk, they mitigate the risk, and then they will arrive into somewhere else. They will turn the risk into something that they can make money out of it.
Got it, Prof.
And entrepreneurs are supposed to be innovative, You know, we know that there are risks, but it is risk taker. They are risk takers. They take the risk. So we look into what affordable loss that we can accept, and then what are the risks that we can accept, what the level of risk that we can accept. That is how we determine, okay, we can accept this amount of risk, we go for it. So there are some expectation of risk. So that's why when you see a lot of entrepreneurs, I mean, a lot of ventures that they do, they might fail in the first time, second time, third time, then they success in the third, and then continuously and so on. This is how we do. Yes, Haziq.
Yes, sorry. Just a quick question regarding your past experience as a valuation. Just want to check, I mean, from your experience, what's the top 3 information that you valued on this, if let's say you want to invest in a company?
Okay, I will look into the look into the product. I will look into the product, what sort of venture, what sort of services are you looking at there. It is the way that I put it up just now, whether there is demand for the product. There is demand. Are there people buying your product? If there is demand, and then you look into the metrics, I will actually look at the metrics, meaning that where is your market? Okay, do you have that market size? If the market size is not really, you just plucking figures from the sky, that's it, meaning it's irrelevant. We do not know whether your figures is correct or not. You need to be able to show that you get some portion of the market size, small portion of the market size, meaning that is something that you can achieve. And then if you want to achieve certain market size, what is your channel? What is your strategy? How do you achieve that market? They must have a strategy to achieve that market. And then after looking into that process, and then I will look into the financial. This is how I do.
Okay, thank you.
Okay. Okay. Any other question? Okay. If okay, can we adjourn early today? Alice, okay? Alice? Azani? Shazana? Akila?
Okay, Prof. Okay, Prof.
Okay. Okay. I'm an entrepreneur myself. I started from 1999 until 2014. I become academic in 2014. I run my own software company. Okay, thank you very much. And then see you again next class. Assalamualaikum.
Thank you, Prof.
Thank you.
Thank you, Prof.